The title of this talk has evolved a little bit relative to what was advertised on the Institute's website, and I will explain why in a moment. Let me first give you the brief outline of what I propose to do for the next 35 minutes or so, after which we can open it up for discussion. The talk will be in two parts. Part one on why the euro and the euro area and Europe continue to experience difficulties. Part two on what needs to be done. Back to the title, why 25 years on? After all, the euro has only existed for 18. Maybe I'm not so good with numbers. This is rounding error. But the truth being known, it is exactly 25 years since my first publication on what was to become known as the euro, which is also my most widely cited publication. It's called Shocking Aspects of European Monetary Integration. The title has been interpreted variously over the years. We were interested in applying the standard framework that economists use to try to understand whether a group of economies resemble what is referred to as an optimum currency area, or they satisfy the preconditions for operating a monetary union relatively smoothly. And that framework looks at the distribution of shocks or disturbances to the constituent economies. If they experience aggregate supply shocks and aggregate demand shocks at the same time in similar fashion, then they can cohabit relatively smoothly within the confines of a monetary union. A single monetary policy will fit all of them if the shocks to which monetary policy has to respond are relatively similar across the constituent economies. So that's one thing we had in mind when we looked at, when we came up with this title. Other people have thought that my co-author, Tam Bayumi, who's at the IMF, and I were disturbed or shocked by the prospect of the nascent monetary union. That wasn't necessarily what we had in mind, although you will see that we were worried about whether a large monetary union in particular would work relatively smoothly. Last time I looked, this was my most widely cited article, with something approaching 2,000 citations according to Google. The bottom line of the article was that a large monetary union encompassing both core Europe and peripheral Europe, or as it's sometimes described, Northern Europe and Southern Europe, would be problematic, that there was a subset of economies centered around Germany, really Germany, the Benelux countries, Denmark, possibly France, across which shocks or disturbances were similarly distributed, but there was also peripheral Europe, Southern Europe, Club Med Europe, where the distribution of disturbances was very different. And if, in their wisdom, European countries chose to go ahead with a large monetary union, they were likely to have trouble. So that's what we did. The framework, the theory of optimum currency areas, such as it is due to Robert Mundell in a classic 4-page article written over half a century ago, but this is still the framework that economists use to analyze monetary unions. Is the distribution of shocks symmetric across member states or asymmetric? How smoothly can the constituent economies adjust if they experience distinctive asymmetric shock? Is labor relatively mobile? Will it move from high unemployment to low unemployment economies? Does there exist a federal fiscal system that can redistribute resources from booming to depressed member states? I would observe that one thing Mundell didn't write about because writing in the late 1950s and early 1960s, he was writing in a period of financial repression, is he didn't make the point that monetary union without banking union could be problematic, and that's something that we will want to come back to in short order. Economists like models. This is the simplest possible model in the entire portfolio of economic models. Supply and demand. In the macro context, aggregate supply and aggregate demand. So we assumed downward sloping aggregate demand curve and an upward sloping short run aggregate supply curve, but in the long run there was some constant level, fixed level of aggregate supply given by technology, the size of the labor force, et cetera, et cetera. You can then run this model through its paces. Imagine a positive aggregate demand shock that shifts the demand curve up and to the right. In the short run, you move up the short run aggregate supply curve to its intersection with the new downward sloping aggregate demand curve. Both prices and output rise in the short run, but the long run level of output is constrained, dictated by the unchanged level of long run aggregate supply. So over time, prices continue to rise as you move back to the initial level of output, but because something has been done, like the central bank has expanded the money supply to goose aggregate demand, prices are now higher than they were before. The effect of a demand shock in the long run is to raise prices, not to affect output. Consider, in contrast, a positive shock to aggregate supply that shifts both the short-run aggregate supply curve and the long-run aggregate supply curve to the right. The system responds by moving down along the unchanged aggregate demand curve with higher output, lower prices in the short run, and even higher output and lower prices in the long run as the system converges to the intersection of old aggregate demand with new long-run aggregate supply. So this used to be what was done in the first week of intermediate macroeconomics. I think intermediate macroeconomics has become more complicated and less realistic than this model, but that's really the simplest framework within which you can ask and answer the question, how would an economy respond to supply and demand shocks? And then use such a framework to try to estimate the distribution of those shocks across European economies. So my co-author and I, back in 1992, estimated these two relationships using annual time series, annual data on GDP and prices, or more precisely on GDP growth and inflation, the change in prices. And we distinguished two shocks, one that was constrained to affect output only temporarily, but prices permanently, as here. And we called that the temporary or the aggregate demand shock. And a second that was allowed to affect both output and prices permanently, the permanent or aggregate supply shock, as here. So we did that using, as I said, data on inflation and growth, regressing each of those variables on two lags of itself and two lags of the other variable, and then looking at the disturbances. We used the results to provide a provisional answer to the question how symmetric or asymmetric were the estimated shocks across European countries. And as a benchmark, a basis for comparison, we did the same thing for 10 US Census regions. The United States has many problems, but it has a relatively smoothly functioning monetary union. There is rarely talk about the need to establish a California peso or whatever. So the distribution of disturbances across US regions is presumably something to which European economies should aspire if they want to meet the preconditions for an optimum currency area. So this is what we found way back in 1992. These are aggregate supply disturbances and how correlated they are or not with the anchor country in Europe, Germany. uncorrelated back here, 0, highly correlated, 1 over here. And these are the aggregate demand disturbances and how correlated they are with those in Germany. Uncorrelated down here, highly correlated up here. And if you're in a monetary union with Germany, you want to be obviously in the upper right-hand, toward the upper right-hand corner, where economic conditions in your country are similar to those in Germany and whatever the ECB is doing, because the German economy is a third of the euro area, will fit your circumstances relatively smoothly as well. And the New York Mid-Atlantic region was taken as the anchor region for the United States. And this is how correlated the different US Census regions are with Mid-Atlantic. So one more point, and then I will take a question from the audience. You can see that US regions, a number of them tended to be further up toward the right-hand corner, as if Europe didn't meet the conditions for a smoothly operating monetary union as closely as did US Census regions. And number two, it looks like Europe kind of breaks down into a core and a periphery. So the core was Germany, of course, and other countries that move relatively closely with it, France, Denmark, Belgium, the Netherlands. And the countries that you wouldn't want in the monetary union under any circumstances were none other than Portugal, Italy, Spain, Greece, and Ireland. We call various acronyms like the PIGS have been used for them ever since the crisis, along with the UK, which in its wisdom chose not to go into the euro area as well. Brad.
Did you look then, or have you looked since, or would it be a wonderful dissertation chapter or first-year economic history paper to look at the correlations among the Club Med? That is, certainly those talking to me when I was at the Treasury who had staffed Maastricht for the great and good thought in terms of one of the five going radically and massively wrong at one point in time, and would say their economies are so small relative to the core Eurozone that it's not a big problem.
So I don't think I don't recall that we've done it. My intuition would be that in this earlier period, the correlation among them is not so great either. You know, this speaks to the desirability of two monetary unions, or two-speed monetary union, or, you know, as people sometimes put it, a Northern European euro and a Southern European euro. I don't think it's possible to get from here to there. I don't think the case for a Southern European euro is particularly strong.
But they were pointing out to us in the Treasury that we had just transferred 30% of a year's GDP to Texas for its savings and loan crisis, and had done so with barely a burp. Possibly because the chairman of the Senate Finance Committee was from Texas. But
right, so I don't know how well that would work in the context of the European Parliament. This is the update. So we use data through 1988. We were writing in the early 1990s. Here are data through from 1994 to 2014, with for the same U.S. Census regions in blue, and the same European member states, EU member states, in red. And I think you can see two things here. Fact number one continues to hold, that Europe doesn't resemble an optimum currency area as close as does the United States. A bunch of the blue points are further up toward the right-hand corner than the red points. Another observation is that demand disturbances have become more correlated within Europe. A number of the points have moved further to the right, and that's kind of what you would expect, since national monetary policies, which differed in the earlier period, have given way to a Europe-wide or a Eurozone-wide single monetary policy implemented by the European Central Bank. How, for the US, blue points, they're distributed in about the same place they were before, although the Great Lakes region, which used to be manufacturing heavy, a lot of that manufacturing has migrated elsewhere, and idiosyncratic shocks are more evident there. What's really striking, however, is look who is correlated now it would appear, with Germany. It's not core Europe anymore, but it looks like peripheral Europe, especially on the side of demand disturbances, but in the case of Portugal and Italy, more generally. Those are the economies that seem to have moved together with the German economy in the more recent period. This is the big surprise. This was the big surprise. From our update, it caused us to look at our computer code about 18 times to figure out whether this was really what the data were saying, and indeed they were. The interpretation I'm going to give you, and I'll talk about it some more, is that we expect that the increasingly strong correlation between economic conditions in Northern Europe, call it Germany, and the crisis countries reflects large capital flows between Northern Europe and Southern Europe that did not exist prior to the euro. Large capital flows from Germany, which was booming, to Southern European countries, which were artificially booming as a result of large amounts of lending by French and German banks to what became the crisis countries. And then the same process running in reverse after 2008, when the German economy decelerates because of the global crisis and the peripheral Europe descends into a major crisis. And indeed, these correlations turn out to be much lower when we control in our regression analysis for a variety of financial variables, that we can make the correlation go away when we take out the financial part is consistent with the idea that these large capital flows, destabilizing capital flows, were what was binding these economies together. There is another twist, if I can go there. You can take this little economic model of two equations and shock it and see how prices and output respond. For the United States, the responses are well behaved. These are the responses to supply and demand shocks in the US case, and they look just like the simple analytical model would suggest they should. Subject the system to a positive aggregate supply shock. You're shifting out the short run and long run aggregate supply curves, and the system should respond with higher output and lower prices. Et voila. You shock the system with a positive demand shock. Prices and output should go up in the short run. Prices should continue to go back up in the long run as the short run aggregate supply curve rotates to its long run vertical position, and output should fall back to where it started, the blue responses. So the US is well behaved, or its behavior conforms to this simple model. In the earlier period, Europe also conformed to the predictions of this simple model. Now, however, for the euro area, post-euro, we get responses like this. These look rather peculiar. They're supposed to look like this, and they clearly do not. So we went back and checked our computer code another 18 times, but this is what the impulse responses for the more recent period look like. How can we understand this? How might an economist try to explain them? We try to explain them like this. Our hypothesis is that now in Europe, when you get a short-run positive, a positive aggregate supply response, that induces endogenously, that's a positive aggregate demand shock through the operation of the financial system, and therefore, with a supply shock, you get behavior like this, which is the red line I've shown you here. And similarly, when you get a positive aggregate demand shock, that induces endogenous supply response. So let me tell you the story about this one, because I think it's most compelling and informative in this case. Our story emphasizes hysteresis, the dependence of the state of a system on its history, and the operation of the financial system. what we call the financial cycle means that positive supply shocks set off a financial response, also affecting demand, and that positive demand shock is permanent. It's not reversed absent some other disturbance to the system. Hence the hysteresis. And the story goes like this. The euro was a positive aggregate supply shock. It reduced uncertainty about the exchange rate. European investors, in their wisdom, thought it had reduced or eliminated exchange risk and credit risk. And you got a positive investment response, a positive productivity response, which raised aggregate supply. But through the the financial system also responded to that, to the expected increase in profitability by bidding up asset prices, funneling a lot of capital from Northern Europe to Southern Europe. The result was a lending boom that infected the European periphery. That lending boom increased aggregate demand. It led to a housing boom in Spain, a consumption boom in Greece, a government spending boom in Greece, consumption boom elsewhere in the periphery, so forth and so on. You got this response, a combination of higher output and higher prices, even in the long run, until it was offset by something else, that something else being the global financial crisis that led the same process to operate in reverse. So you got the global financial crisis. That's an impairment of the European banking and financial system, making it less efficient. You get less supply. The supply curve shifts back. The demand curve shifts back because the lending boom moves into reverse. So that's what we think was going on here, and in the interest of time, I will skip the other case, which I think you can analyze analogously. That's my conclusion to part one in two halves. It's no surprise that the euro area continues to experience difficulties. It remains further from the benchmark represented by the United States of satisfying the conditions for an optimum currency area. Shocks in Europe still are more asymmetric, more idiosyncratic than in the United States, and we know as well that adjustment remains difficult because we don't have Senate Banking Committee to transfer resources from other states to Texas in a banking crisis, lower levels of labor mobility reflecting linguistic diversity in Europe, et cetera, but part two is new. The evidence suggests that while the euro had positive efficiency effects, those positive efficiency effects unleashed large capital flows between Northern Europe and Southern Europe, inflating asset prices in the South. That lending boom boosted demand in Southern Europe, creating the mirage of prosperity, but also leading to a permanent loss of competitiveness, suggesting the need now to do something in Europe about this destabilizing financial system, this capital flow problem, and its effects. So part two is what to do. One can imagine, depending on one's temperament, different answers to this question. So if you're a fan of Star Trek, you would say the Europeans need to go where no man has gone before and move all the way to a full monetary union, fiscal union, and political union. They need to mutualize government debts. They need to establish a true single labor market, but we know this is not in the cards, not in our lifetimes, that the appetite for a federal Europe is simply not there. Given this, the question becomes, can we imagine more limited steps that European economies might take to make their monetary union operate tolerably well, and if not, should they simply declare the experiment a failure? So my argument is that for relatively limited steps, limited by the standards of full monetary, fiscal, and political union, all of which are possible, will suffice for the survival of the single currency. And those four steps are establishing a normal central bank, finally, which I would be prepared to argue has largely been accomplished. Completing the banking union, not accomplished. Repatriating or renationalizing fiscal policy, and removing debt overhangs where they are a problem. I come to these recommendations again from a simple economic model, from basically the club theory, which provides a guide for thinking about what functions absolutely have to be centralized at the level of the monetary union, but what other functions can be delegated to the individual member states. So what does club theory a la James Buchanan, a la the principle of subsidiarity in Europe, tell us about when functions should be centralized and when they should not? It tells us that when tastes are similar, relatively homogeneous, spillovers between in this case, the constituent member states are significant, and there are therefore increasing returns to collective action, to internalizing that spillovers, and nobody minds because they all have similar preferences. Decision-making should be centralized. But in contrast, where spillovers are more limited and tastes or preferences differ, they're more heterogeneous, responsibility should be decentralized, should be delegated to the member states. So that's the simple framework that I use to think about monetary policy, banking policy, fiscal policy, debt policy. Monetary policy. I define a normal central bank as one able to pursue flexible inflation targeting, but at the same time backstopping banking systems and markets and government bonds when they are subjected to destabilizing, self-fulfilling attacks. I think both theory and evidence argue strongly for centralized provision. We know that the spillovers of monetary policy and doubts about the integrity of the euro area are powerful. And since this is a US-based audience, I can argue freely that tastes over inflation in Europe are relatively similar. Everybody in Europe is tolerably happy with it, a 2% inflation rate, give or take. So those observations suggest that the conduct of monetary policy should be centralized. The problem being that the European Central Bank didn't act like a normal central bank for the first decade plus of its history. Its two-pillar strategy focused on inflation and monetary aggregates, not at its lender and liquidity provider of last resort functions. Even that inflation targeting was asymmetric, not a 2% inflation target, give or take, but at or below 2%, which got it into dangerously deflationary territory. And the ECB mistakenly concentrated on headline rather than core inflation, which led it to some disastrous mistakes like raising interest rates in 2008 in the teeth of an unprecedented crisis, and again twice in 2011, even after it was clear that the euro area was in the throes of an existential crisis. I think things have changed for the positive under Draghi, with do whatever it takes, with outright monetary transactions, an instrument for doing whatever it takes, now with a symmetric inflation target, now with quantitative easing to achieve it. I think basically what the European Central Bank needs to do now that it has acknowledged it has a broader range of responsibilities is to become more transparent. If you have more responsibilities, you have to be more transparent so that the polity can hold you accountable for your actions. And I think the ECB needs a smaller and more nimble policymaking committee so that it can respond to events more quickly. Banking union. Here's another case where the argument for centralization is overwhelming. We know that spillovers from one country's banking system to another country's banking system are immensely strong. We know from this earlier discussion of cross-border capital flows that French and German bank supervisors and regulators didn't adequately take into account the impact of their own supervisory decisions on other European countries. And that's why the decision was taken in 2013 to create a banking union to complement the monetary union. A point underscored, I would argue, by these earlier findings on the financial cycle. The problem is that Europe still has only half a banking union. It now has a single bank supervisor, only for the 130 biggest banks. It has a mechanism called the Bank Recovery and Resolution Directive to wind up and recapitalize bad banks, but that mechanism has not proven workable in practice, and it still doesn't have harmonized deposit insurance with a common financial backstop like you would want in a full banking union. So here they still have a ways to go. Renationalization of fiscal policy. This gets me into trouble whenever I talk about this in Europe, but I can safely talk about it here. We all understand that the cross-border spillovers of fiscal policy are small. My fiscal policy, German fiscal policy, doesn't affect the Greek economy very much, and Greek fiscal policy doesn't affect the German economy virtually at all. The reason for that being that my fiscal expansion has two offsetting effects on your economy. If I have a fiscal expansion and spend more, I'm going to suck up more of your exports, good for you, but I'm going to drive up interest rates all over the monetary union, bad for spending by you. And the two effects more or less net out. We are told this by no less an authority than the European Central Bank in working paper 2040 dated March 2017, where they did the relevant model simulations. And we know there's no area of public policy which is a more sensitive national prerogative than who to tax, how heavily to tax them, and what to spend the money on. European countries have very different preferences over those things. So this is an argument for not centralizing fiscal policy. The other argument for not centralizing it is that all the attempts made to centralize it so far have not worked. There's the Stability and Growth Pact, didn't work. The 2-pack, the 6-pack, a variety of other pacts, none of which have been time consistent or enforceable or whatever. So this is an argument for renationalizing fiscal policy and letting individual European countries choose their fiscal policy. Because if they misbehave, they bear the consequences, and their neighbors are not much affected by those negative consequences. So long as there is a credible no bailout rule, that countries that misbehave fiscally don't automatically get bailed out, and I think that requires disconnecting banking systems from sovereign debt markets. The reason countries have gotten bailed out over and over again is the fear that if Greece defaults, the Greek banking system, and by implication the German and French banking systems, which lent Greece much of that money, will become destabilized. So the banks have to be bulletproof, they have to hold more capital. The fiction that government bonds are risk-free and that you don't have to hold capital against them has to be eliminated, and I think renationalizing fiscal policy also requires removing inherited debt overhangs, restructuring debt where it's unsustainable so that governments can actually use the fiscal economy that they've regained. So that brings me more or less to the end, to the concluding question: does the euro area need more integration or less integration? This analysis has made the answer clear. It needs both, and club theory points to the dimensions on which it needs more or another. I'm going to make a final point, if you indulge me. People continue to talk about two-speed Europe, maybe because Wolfgang Schäuble wrote an influential article in 1994 about two-speed Europe, and because people like Macron and Schulz are talking about it again. There should be a core of European countries that are in the monetary union, in the banking union, that move toward fiscal union, that move toward political union, and then there can be a slower cohort of European countries that are moving at the slower speed. What I've just described suggests that this is not a way forward. This is not the right model. That there will be a variety of different clubs overlapping with different membership depending on tastes and conditions. So I show you a figure from The Economist magazine depicting visually a number of these different clubs. There's the Schengen club of passport-free club. Denmark is in, but there's the Euro club. Denmark is out. There's Ireland is in the Euro but out of Schengen, etc., etc., etc. So this suggests that two clubs is not the right model. There is a whole series of overlapping clubs. This idea...
I myself by asking what the EEA is?
European Economic Area.
Okay.
Which is kind of a glorified free trade area. This overlapping clubs idea had a name once. It was called flexible integration, and Google Ngrams suggests that it reached its height of popularity about 10 or 15 years ago, after which it has fallen out of fashion. Nobody refers to it anymore. Why not? I think because of uncertainty about how to solve the governance problem associated with it. People who worry about governance and accountability and don't want to delegate decisions in Europe to Mr. Juncker or simply to Mrs. Merkel and whomever her French counterpart is about to be, suggests that there need to be a number of different, there needs to be a European assembly for each important club. So there's the European Parliament for the EU of 28. People like Thomas Piketty have suggested then there should be a Eurozone assembly operating separately to make decisions about policy toward bailouts or whatever for the Euro area. Again, my little club theory framework suggests that 2 is not the right number, and you need to think more systematically about the governance problem. In addition to 2 not being the right number, Piketty's model of national parliamentarians sitting along members of the European Parliament in this Eurozone assembly assumes that national parliamentarians have the bandwidth, the attention span to participate in 2 assemblies, and that national parliaments will reorganize when they do business to free up their parliamentarians for this Eurozone assembly. Actually, that model was one that the European Parliament used, delegating national parliamentarians to the Brussels Parliament before 1979. It didn't work, and they moved away from it. So I think the solution is to work within the framework of the European Parliament and have different subcommittees, if you will, different subsets of voting members. One of MEPs from Schengen countries who vote on Schengen-related issues, one of MEPs from Eurozone-related countries who vote on Euro-related issues, and so forth. People don't like the European Parliament in Europe. They don't think it's particularly serious or accountable, but with more powers along these lines, they may pay more attention to who they send to Brussels and what those people do. I think there's also an argument in this context for direct election of the proto-president of the European Commission, of the European Union, the president of the Commission. They've got a really strange system at the moment where the Council, basically the heads of state, select a candidate, and then the Parliament votes that candidate up or down. That puts 2 layers of separation, 2 degrees of separation between the people and selection of the president of the Commission. I think it will become more important for the people to vote on the President of the Commission as the proto-executive branch in Europe gains more powers over border control, security policy, foreign policy, a variety of other non-economic things that will have to be advanced at the European level. There are obvious objections to direct election of the President of the Commission. He can't possibly campaign in all 27 member states, although our presidential candidates campaign in virtually all the 50 states. People speak different languages in different European countries, but people speak somewhat different languages, if you will, in different US states. So I think these are problems that can be overcome. So I went on too long, but thank you.
Thank you so much.